There's been widespread optimism, but some concerns as well on the IMF's International Monetary Fund's latest statistics or data on the India growth story and the GDP numbers. Joining us now, Harald Finger, he's the mission chief for India, to explain a little bit more about what the numbers mean. Thanks so very much for being with us. So given the IMF 6% growth for India's 2025-2026 financial year and the strong Q1 performance of 7.8%, what specific domestic factors, such as consumption or investment trends, do you think will be perhaps most critical in sustaining this matter?
Yeah, Vishnu, India's economy has shown remarkable resilience thanks to mostly to strong domestic conditions. In fact, GDP growth in the June and September quarters came in at 7.8 and 8.2% respectively, well above our expectations. And this remarkable performance was mainly driven by buoyant private consumption, and that's been benefiting from lower inflation, which is boosting consumers' real purchasing power. And it's also been boosted by supportive policies, including the monetary easing we've seen over the course of this year and the personal income tax cut. And then apart from that, I would say that front-loading of central government capital expenditure has helped to boost public investment, but private investment probably has remained a little bit more subdued, we think. And strong growth in the September quarter bodes well for continued growth momentum in the current quarter as well. And so I would say that with the new GDP data released last Friday, there are now significant upside risks to our forecast, which we will revise next month. And we think that private consumption will remain an important growth driver. And in addition to the factors I already mentioned, we also add the cut of the GST, strong demand during the festive season, that are also supporting consumption in the current quarter, Vishnu.
So how does India's projected 6.6% growth rate outpace, let's say, China, which I think was 4.8%? How does that position India as a leader among emerging economies? And specifically, what policy recommendations would the IMF have to help India to maintain that relative strength given global trade dynamics, which are such a concern at this stage?
Yeah, indeed, India remains the world's fastest growing major economy. In recent quarters, strength in demand has come from India's large and growing domestic market rather than from net exports, as I said. But nonetheless, to accelerate India's development path, a strong focus on exports will be important, as competitiveness in export markets is the ultimate test of companies' efficiency, and the growth model of so many other countries that have been successful in driving development has had a strong export focus. And so with that in mind, we think that further trade integration will be key for India. And the recently concluded India-UK free trade agreement already brings opportunities for India. And I would also add the recent revocation of a number of quality control orders will be a positive, particularly for industries affected by the 50% US tariffs. And building on that, we think India can continue with ongoing trade negotiations with a view to bringing them to a swift conclusion. And this includes not only the US, which is on everybody's minds these days, but also the EU and a number of other economies. And beyond it, integration in regional and even broader trade agreements, such as the Trans-Pacific Partnership, would also be helpful for India.
So, I don't know if you've seen several of the headlines in India, which are focused on India's national accounts securing a C grade in the IMF annual report. But, your overall assessment seems to be quite positive, as you indicate to me over here. So could you clarify the data on the national accounts securing a C grade? Why is that the case?
Yes, this is based on the existing methodology that MOSPI is following right now for the national accounts, which is somewhat outdated with a base year that is much older, much more than 10 years old, and a technique for deflation to go from nominal to real GDP that can be improved. So with things like this, that led us to give a C rating, also taking into consideration and comparability across countries globally to make it a fair rating. But that said, significant improvements are underway. We're in close discussions with MOSPI and supporting them also through technical assistance. And the new GDP series is expected to be launched next February. that will take care of many of the things that I just mentioned, including updating to a much more recent base year and improving the methodology used to go from the real to the nominal and the nominal to the real. And with that, we will reassess the methodology come February for next year's consultation.
So I'm just trying to understand you. I mean, you were mentioning or you're talking about sanctions, and you know the challenges which that poses. In simple terms, if the sanctions on India from the US are not lifted anytime soon, what impact would that have, in your estimate, on the India GDP growth numbers?
Yeah, I should begin by saying that our GDP growth numbers are based on the assumption that these tariffs are staying in place for the foreseeable future, which is a technical assumption resulting from the fact that at the IMF we are asked to make our projection on trade policies that are actually in place now and not ones that could be expected. Of course, we hope that the trade issue with the US is resolved very soon, and if that's the case, then that would constitute an upward risk to our projection, particularly for next year. Next year's projection would come out at 6.2%, but that may be too low, particularly if this trade issue is resolved quite quickly.
So that's important. So we are seeing as if the issue, on the other hand, if the issue is resolved, if there is a trade agreement with the US, which as I understand it appears to be on the cards, perhaps later than sooner, but it should happen, then are you suggesting that there's a possibility of the GDP numbers presented by the IMF actually being revised on the India story?
Yeah, we're in the process of updating our projection for all years, for 2025, 2026, and beyond. And if there's a swift resolution of the trade issue with the United States, then that does constitute an upside risk to our forecast. So we would likely be revising up. Anyway, because of the strong GDP numbers that we just saw from last Friday, there's a significant upside risk now to our projection also for the near term. So stay tuned. We will have a projection coming in January.
So that should be quite interesting with global forecasts to slow to just above 3% in 2026, amidst risks like fiscal vulnerabilities, financial market conditions. What steps do you believe India should take to rebuild our fiscal buffers while pursuing structural reforms, some of which you've highlighted?
Yeah, let me start by saying that India has already begun rebuilding its fiscal buffers by gradually reducing the fiscal deficit after the pandemic. And this year's fiscal target of a central government deficit of 4.4% of GDP is within reach, although budget execution will require significant discipline in order to meet that target. For next year, our fiscal advice will depend on the impact that India will see from the 50% US tariffs. The initial data for September and October may point to a somewhat milder impact, at least in the initial data than we had feared when the tariffs were first announced. But I think it's too early days and it's too soon to jump to a conclusion. And we also discussed that the quick resolution of the tariffs, of course, will affect the picture there. So if tariffs are resolved soon, or if the impact of continued tariffs turns out relatively mild, then we would suggest a continued deficit reduction also next year. But if the shock conversely turns out to be more pronounced, then a pause in the consolidation for next year could be considered. For the medium term, the government has set a target of achieving a debt ratio of 50 plus minus 1% of GDP by fiscal year 2031. And on our calculations, this appears achievable even without new fiscal policies. So we think that some more ambition could be considered there. Faster consolidation would ease India's very high debt service burden sooner. Remember that India's interest payments alone absorb more than a quarter of fiscal revenue. And so bringing that down over time will free resources for other and maybe higher priority expenditures. And also it'll help rebuild fiscal buffers for any future shocks. And with the GDP rebasing next February that we discussed, there would be an opportunity to review the target and hopefully with the aim to making it more ambitious. Now, how should India go about deficit reduction? India's revenue as a share of GDP is solid, of course, but not high relative to well-performing emerging market peers. And so there's space for more revenue collection, and consolidation plan centered on revenue-based measures could achieve the warranted consolidation while also creating additional space at the same time for high-quality investments and other priority spending.
Right, Mr. Finger. Well, let's just hope that the India numbers do get revised sometime in January, perhaps. But thank you very much for being with us.
Yeah, thank you so much for having me on, Vishnu.